Hello and welcome to this edition of Money in Motion video blog. This is Dan Perkins and thanks for watching. Well, let's take a quick review of the quarter. The S&P 500 had a zero return, literally less than 1 point on the S&P 500 from January 1st to the end of March. We, on the other hand, virtually almost every account was up. So everybody beat the S&P 500 in a difficult month with the tremendous volatility, especially the last month of the quarter in March. And we're starting off April with more of that same volatility. The market is trying to figure out what is going to be the impact of this rising dollar and lower oil prices going to be on the economy. If we just take a moment to talk about our three indicators, gold, 10-year treasuries, and oil, not much has happened. We're in the upper end of the range at about $50 a barrel for crude oil, below $1,200 for gold, and interest rates have come down as the market's got more volatility, so the yield on the 10 years is about 185, but no significant change from last month, or for that matter from the beginning of the quarter. I think the surprise, there were actually two surprises last Friday. One was the 125,000 new jobs, about half of what was expected, but more importantly, a downward revision of almost 70,000 in the previous 2 months. Some of that clearly could be weather. However, as the weather improved, the unemployment statistics got worse. Right now, we are at 93 million people unemployed, and we have the lowest work rate, meaning the number of people, the percentage of potential people employed, at less than 62%. So the economy is not creating a whole bunch of new jobs. The economy is slowing, as by the final revision on the fourth quarter GDP at about 2.2%. So with supposedly all the jobs that's being created, we're also not seeing any real change in the hourly wages. The Federal Reserve has two mandates. One is employment and the other is inflation. Because of the decline in oil prices and the rise of the dollar, inflation is not an issue, less than 2%. And unemployment, which is at 5.5%, is a problem. People are still confused that if we added 125,000 new jobs, why did the unemployment rate stay unchanged at 5.5%? For that matter, as we were losing jobs, why was the unemployment rate going down? Excuse me. The unemployment rate is a function of the number of people working. And once you have exhausted all of your unemployment benefits, which now stands at about 2.8 million people, you're no longer counted. So we have about 93 million people who have exhausted benefits or cannot find work. And therefore, with less than 63% of the economy working, that's why we have such a high number of unemployed, but at the same time we have a 5.5 to 5.6% unemployment rate. Let's talk a little bit now about the markets. I've been saying to you that the markets are volatile, extremely volatile, as you see them move 300 points in a day, either direction. And yet there's been no real progress. As I said, the S&P 500 was virtually unchanged, zero return through the end of the first quarter. The markets are really fussing with trying to figure out, one, what's going to happen to the economy when corporations who are multinationals are now starting to convert their earnings from foreign currency into U.S. currency. When that conversion is made, the strength of the dollar versus the foreign earnings is going to make the foreign earnings worth less. So we have to watch the earnings reports coming out here now in the beginning of the second quarter to see how much foreign currency has had an impact. In addition, with the economy slowing to probably under 2% for the first quarter, we have to be concerned about what's the momentum of the market. Clearly, terrorism is accelerating around the world, and the most recent developments with the 150 college students who were massacred in Kenya, what's going on in Iraq and Iran trying to overcome ISIL. A lot of dislocation. The uncertainty as to whether or not Iran is going to honor even any parts of the treaty and is going to continue to build its own nuclear capacity is a real concern to me and to many other people. So the world is a much more volatile place, and as a result, the markets will be more volatile. The European Union is just starting in its quantitative easing. Rates are down and negative, for example, in Germany. You have to pay the government in order to buy government bonds. And we don't know how long it's going to take them and how long they will stay in this quantitative easing period, but I suspect for a significant period of time. We're also seeing some weakness in China, and as their exports diminish because of the overall global slowing. So volatility is going to be around for a while. It is this kind of volatility that, if you have cash, presents potentially some buying opportunities, which we have cash, and I'm looking, but I'm in no hurry to put money to work until I can see a more clear pattern. I'm not going to wait for the market to rally 1,000 points to put money to work, but I do think that there's a possibility that we may be within striking distance. I said that I felt that oil had to go back and test the lows, which it did, and set new lows. We'll have to go back and test those new lows and see if they're going to hold. I suspect when we get into the season, the summer driving season, we're going to see that the stockpile of crude oil in the United States there's going to be no place left to store it, which is going to cause some significant price declines of U.S. crude. So I think it's very possible by June or July we could see crude oil in the United States under $40 a barrel. That makes it difficult for some of the oil companies to make any money, and there's going to be some dislocation in that business. Those that are well capitalized can hang on through this and see what happens. Those that are operating on a shoestring are probably going to go out of business. We don't own any drillers. We only own the oil in the ground and the transportation pipeline companies and the shipping companies that move it. So we don't have the exposure of default on drilling operations. I think that the second quarter is going to be as volatile as the first quarter, sometimes a little more. But I still wouldn't be surprised at the end of the second quarter we look back on the year and we're still flat to maybe down a little bit on in the markets through the end of the second quarter. It's a difficult time. I know you don't like the volatility. I know you'd like to see your statements go up more than they're going up, but take a look at it this way. If the market was zero and you earn 1 or 2%, you're doing really well. So if you have any questions, please feel free to give me a call. And if you have friends or neighbors who are looking for a real manager, give them my name and number. This is Dan Perkins, and thanks for watching.